Okay, hi students. How are you? Can you hear me?
Can hear you.
Okay, so let's start the class. Till the last class we have covered traditional costing. We have covered ABC, activity-based costing, and then we have talked about the concept of target costing. So now we will continue the lecture uh, from the target costing. First of all, we will revise the target costing quickly. Then we will discuss the concept of life cycle costing, and then we will talk about throughput accounting and environmental accounting. The activity-based costing, target costing, life cycle costing, throughput accounting, and environmental accounting are also known as a new development in management accounting system. Traditionally, we have only one costing system, which is uh, absorption costing. But as we talked about in the last class, that with the modernization and innovation in the technology and with increasing the computer a certain limit, so the price is cannot be changed. You cannot charge the high price. The price is constant. So you have to sell a product within a price. So in the target costing, you take the price from the market, we deduct our desired profit margin, and the difference of the price and the desired profit margin is the target cost. And target cost is basically the cost in which we will try our best to complete our product. And if we can make a product within our target cost, then we can earn our desired profit. The steps in the target costing work. First of all, we need to determine the price which market would be ready to pay. Then you have to deduct the required profit margin. Then you have to estimate the estimated cost, actual estimated cost, and then you have to identify the cost gap. And we need to narrow down or minimize that cost gap. The cost gap, is a difference between the expected cost and the target cost. So your target cost is $12, but your expected cost is $15. So there is a cost gap of $3, which need to be reduced, which need to be minimized if an entity wants to earn the desired profit. Let's say, activity one, exclusive motor is designing a new version of its luxury car, Z123 series. The vehicle will be launched in the next year. It is expected to have a life cycle of 10 years. The production of car will require an investment of $3 billion US. Company needs 20% profit a year on this investment. The marketing department believes that car could be sold for $40,000 each, and when 1 lakh car would be manufactured and sold each year. The requirement is to calculate the target cost. So your price of a car in which you can sell the car is $40,000, and you're going to sell 1 lakh cars. So 40,000 into 1 lakh, 4,000 million will be the total revenue. And your required margin is 20% on your initial investment. And your investment is $3 billion US. And 20% of that is $600 million US. So your target cost will be 3,400. And the per car target cost will be 34,000. Alternatively, you can do it per car as well. Your sale price is 40,000, and your target sale price profit would be 20% of 3 billion divided by 100,000 cars. And that will be $6,000 per car, and you will achieve 34,000 your target cost. Alternatively, you can do the calculation. Sale price per car is 40,000. Your desired profit, if you want to earn, is 20% of 3 billion US dollars, and you are going to produce total 100,000 cars. So 6,000 per car is desired profit margin. So your target cost per car would be 34,000. It can be done in this way as well. The concept of target cost is can also be applicable on a service industry. Normally, in this subject, we are more talk about the manufacturing concern. Absorption costing is purely for manufacturing concern. ABC as well. The target costing, where it can be applied on a manufacturing industry, the target cost concept can also be applied on a service industries as well. The target cost is more likely appropriate manufacturing, where the volume of standard product is to be made, although it can be used in a service industry. But when you will apply in the service industries, there will be some challenges. For example, in many service industries, the products are non-standard and customized, and it is difficult to define a target cost when there is no standard product. In manufacturing company, if we talk about a car manufacturer. In a car manufacturer, we have a standard production process, we have a standard car size, where we have some standard, where the products are similar. The concept of target cost is easy to apply. It is easy to achieve the target cost. But if you talk about a business where the products are not same, each product is different, then obviously it would be very difficult to achieve learning curve, labor efficiency, material efficiency. So in such industries, in such a concern, obviously it is a very difficult task to minimize the cost or to achieve the target cost. And service industry is one of that industry. In service industry, each service is different from another, even in a same sector. If we talk about in a business advisory, every entity would require a different type of management services. Every business would have a different demands relating to their business operations and business consultancy. So there is no standardized service which we are delivering. So that would be a challenge in a service industry, that in such scenarios, it would be difficult to achieve the concept of the target cost. A high portion of the expense in the service industries are indirect. It is harder to reduce these on product by product basis. You can reduce the direct cost easily as compared to indirect cost. In manufacturing, obviously direct labor, direct material is a significant part of the cost. You can manage them. But in the service industry, the indirect costs are the significant one. Reducing costs in a service industry may be at the expense of customer service or quality. Now, to achieve the target cost, obviously you have to reduce the cost. Now, in a service industry, the cost cutting means the low quality service, customer dissatisfaction. In manufacturing concern, you can achieve it. You can achieve the target costing with the given quality standard, because there are a lot of scope in terms of learning curve, labor efficiency, raw material wastage control. So that would be easy to achieve in manufacturing. But in service industry, if you are going to cut the cost, that means you are going to sacrifice the quality of the service, and it would lead to customer dissatisfaction. So cost cutting may lead to the losing the customer, and that would not be a right thing. So it can be applied in the service industry, but it would be a bit challenging to use target costing in a service industry as compared to manufacturing. Now, let's say we have an example as well of target costing for services. Like Gates and Jobs company is a tax advisory business. There is much competition for tax services in a market where Gates and Jobs is located. And one competitor has recently started to advertise that it will do tax return for a flat rate of $100 per return. Gates and Job company has decided to match this price for a basic tax return, provided that client has no capital gain tax to pay. Gates and Job currently aims to make profit of 20% on all fees charged to a client. The target cost of the tax return is therefore the price would be 100 because market is competitive, and you want to earn a margin of 20, so you have to deliver the service at the cost of $80. Now, based on the observation and discussion with the management accountant, the actual cost of typical tax return is as follows. Time of a senior advisor is $15 per hour, so $15. Time of a partner review is 15 minutes, $100 per hour, so $25 for a partner. So the total direct cost is 40, and overheads a portion are 60. So your expected actual cost is 100, and your target cost is 80. So there is a cost gap of $20. Now, if you want to earn that profit margin of $20, you have to minimize, you have to basically reduce this cost gap to zero. So although it can be argued that the price of a tax return of 100 does cover all direct costs and therefore increases contribution, the partners are keen that all service should contribute to the business overhead at 120% of the rate. So it would be an application of a target cost. Now, now you have to reduce the cost gap. Now, how you can reduce the cost gap? You can reduce the cost gap by reducing the time taken by the senior. They are taking 1 hour, so you can reduce it. Now the senior is taking 1 hour for $15 per hour. You can reduce it. And how you can reduce it? There is one possibility using a software package. Now it's time of information technology, AI time. So if you can have a software which can review the return prepared by the trainees, then a software can do numbers of reviews within an hour as compared to senior. So there you can reduce the time. You can reduce the partner time. For example, the partner may be required to review only important returns, not the basic returns. That would help to reduce the cost. You can use ABC costing system to identify to allocate the overheads more accurately. At the moment, they are using the flat 150% of the direct labor. If you use ABC, that might lead to less allocation of the overhead to the tax return. So these things can be taken into account to reduce the cost gap. Now we talked about in the last class that how we can reduce the cost gap. We can reconsider the design of the product to eliminate the non-value added feature from the product. We can reduce the number of components or standardized components, use less expensive material, employ lower grade staff, invest in new technology, relying less on human power. You can invest in technology. You can outsource your business element, which may reduce your management cost, overhead cost. So this is how you can reduce the cost gap. And the following, there are some techniques which we can use. One is tear down analysis. It is also called reverse engineering. Reverse engineering involves examining competitor product to identify possible improvement or cost reduction. So you examine, you analyze the technology of a competitor, the production process of the competitor, that how they are managing their cost. So you, if reverse engineer that process and you can review it carefully, you may find the opportunities, or you can find the ways to minimize the cost or reduce the cost or improve your product. So that could be used, this technique can be used here down analysis. Value engineering. Value engineering means you can investigate, you can analyze that which features are valued by the customer and which features are not valued by the customer. Now, if some features are not valued by the customer, you can avoid those future features in a product. And by reducing those features in a product, obviously, you can reduce the cost of the product as well, and it would help you to reduce the cost gap. Value engineering, it is called value engineering. Functional analysis. Functional analysis involves identifying the attributes, function of the product at customer value. The price the customer is prepared to pay for each function is then determined. The function should be dropped abundant if the cost providing it exceeds the value it generates. Business should ensure that any step taken to reduce the product cost do not lead to lower the perceived or actual quality, as it may reduce the price the product could sell for. This would then reduce rather than increase in the margin from the selling product. Increasing the sale price is not a viable method to reduce the cost gap. We practiced in the last class, and there were a number of questions where we identified to reduce the cost gap, we should not increase the sale price. Because the target costing is using on a concept that you cannot increase the sale price, the competition is high. If you increase the sale price, obviously you will lose the customer. So increasing the sale price is not an option in the target costing, in a target costing. But, and then what is the option? To reduce the cost. If you reduce the cost, expected cost, actual cost, then the cost gap will be minimized, and then you can earn your desired profitability. Okay, so that was the target costing, target costing. Now, the next concept we have is a life cycle cost. Now, let me elaborate first of all. Then we will talk about the life cycle costing in detail. Now, if we think like a typical accountant who always taking the period-wise profitability. Now, let's say if we are thinking with the mind of the accountant, I have made a product, and obviously in an initial stage, like in a year one, if the sale from the product is $1,000, the cost would be $1,500. So I have a loss of 500. In a second year, revenue is 1,200, but the cost is now 1,600. So now again, I have a loss of 400, and accumulated loss I have is $900. In a year three, the revenue is 1,200, but the cost is 1,700. So we have a profitability of 300. So accumulated loss is now 600. In a year four, revenue is 3,000 and cost is 2,000. So profit for the year is 1,000. Now I have the accumulated profit of 400, and so on year 5, year 6, and year 7. Now, if I'm thinking with a mind of the typical accountant, maybe in a second year, I would take a decision to discontinue the product. And you know that decision would not be viable or advisable, because we know that in the initial year, every product will make a loss. The success take time. The profit takes time. The product will take time to establish. And once the product is established, then it will start to take earning, will start to make profit, and then we will start to recover our. So if I talk about with the mind of the accountant, I may discontinue in a tool. But if I think with a mind which is more than an accountant, not only thinking about the profitability of year 1 or year 2, but a person who is reviewing or looking at the total life of the product from inception to decline. There is a concept of product life cycle, and this is a product life cycle. There is inception, there is development, there is growth, there is maturity, and there is decline. Now, this cycle is a product life cycle. So, we should analyze the performance of the product over the life of the product, not according to a particular year. So, if you focus on the example which I have given you, you can see that ultimately the profit starts to make a profit and we start to recover our cost. So whenever we take a decision about a product, that whether the product is successful or whether the product is a failure, we should take or we should consider the whole life of the product life cycle, not only 2, 3, or 4 years. If we do not consider the total life of the product life cycle, then obviously the decision we are making would not be appropriate. Now, this is another concept which we are going to talk about, life cycle cost. It is also a concept of a modern costing techniques or modern management techniques. So the target costing emphasizes the cost control through good product design and production planning. But those upfront activities also cause cost. Now, we talk about the target costing, and in target costing, we talk about introduction of a new technology. We talk about redesigning the product. And obviously, when we are going to redesign the product, in initial year, at the start, it will take a cost. The cost would increase. Now, I am using the target costing, and I see that in the initial year, the cost is increasing. And I am using the target costing with the hope that cost would be reduced. I am redesigning the product that the cost would be reduced, but the cost is increasing. But we need to take some breath. We have to be patient, because obviously when we will redesign the product, when we will introduce a technology, obviously in earlier there will be an increase in the cost. But eventually, in a long run, cost will be reduced and you will recover your every penny which you have spent in the earlier. So there will be an increase in cost in the initial year. So we do not discourage that cost is increasing, but because we have to look over the entire life cycle of the cost, not only 1 or 2 or 3 years of the product. So there might also be a cost incurred after a product is sold, such as warranty cost, plant decommissioning cost. Therefore, to profit from a product, its total revenue must exceed the total cost. Now, this concept, your total revenue should exceed the total cost. So in the life cycle costing, we should not consider revenue of 1 or 2 years. We should consider the total revenue of the product over the life of the product, and total cost of the product over the life of the product life cycle. And then if our total revenues are exceeding the total cost of the product, when I say the total cost, that means cost which is starting from the idea of from the time where I have generated the idea and the time when I exit the market after the declining idea, inception, development, growth, maturity, and then decline. This is a total life cycle. So the cost from idea till decline when I decide to exit the market. If the total revenue over that life cycle and that total and when I compare that total revenue with that total cost, and the total revenue is more than that cost, then I should go ahead with the product because product is profitable. Yes, if the things are vice versa, then we can take other decisions. So this concept is a life cycle cost. So definition of a life cycle costing is a system that tracks and accumulates the actual cost and revenue attributable to each product from development to abandonment. Now that system is known as life cycle costing. Like here in this example, I'm considering the total revenue. And at the end of the year 4, you find that we are in a profit. Our revenue is more than our cost. Like 1,000, 1,200, 2,200, 4,200, and 7,200. The total revenue is 7,200. The cost 15 plus 16, 31, 31, 48, and 268. The total cost is 6,800. So overall, we are in a profit. Now, this is basically the concept of life cycle cost. Now, this is the graph. This is the graph to elaborate the concept of life cycle cost. Now, you can see this is the timeline. This is the dollar value at a y-axis. And then we have different lines. This line is a sale. And then we have the line of a cash flow. And third line is a cash flow. And the second line is about the profitability. Now, at the start of the time, you have just an idea about the product. You will start to work on your idea. And obviously, when you are doing research work on your ideas, you are incurring only the cost. You are incurring only the cost. If you take an example of in a recent history about the successful businesses, when I talk about the recent history, I am talking about last 15 or 20 years. You can like Facebook Meta. Initially, obviously, it was an idea. Initially, they would be working on an idea, and in the idea stage they would be incurring cost. So initially, your product will be in loss, and then when you start to work on your idea, you are developing something. So this is a development phase. Again, in a development phase, you are incurring only cost. There is no revenue, so you have the loss. Then after development, you will introduce your product. This is introduction of the product. Now, in introduction, you will start to generate sales, but you are still making a loss. Introduction. Then after introduction, you will enter in a growth. Now, in a growth, initially you will be having a loss because in a growth, revenues are increasing rapidly. But to support the growth, you have to do more advertisement. You have to do more research, more innovation. So there will be more expenditure. But then there will be a time come when the losses will start to recover, and at some time in growth, before the maturity, you will enter in a profitability area where now your total revenue start to exceed the total cost. And after that, you have a huge profitability till the product becomes mature in the market, where the profit becomes stable. Now, in a maturity stage, Obviously, there will be less expenses in the marketing advertisement because product is already familiar among the customers. Yes, you have to uh, invest something to keep the to retain the market share, to keep the product updated. You obviously you have to incur some innovation, but that would not be a huge cost as compared to the total revenue. So your profitability will become stable, and then you will do everything to extend or prolong the maturity stage maximum as possible. But ultimately, there will be a time when your product will start to become out fashioned and it will start to decline. And in a decline, you will start to lose your profitability. And in some time, in a point of the decline, before you enter in a negativity, in a loss-making area, or in a negative cash flows, you have to decide to exit the product. So you can see in a graph when you are looking at the overall life cycle of the product, we can see in this graph that ultimately our total revenues are exceeding the total cost and we are overall profitable in a profitable situation. So whenever we analyze a product, we should analyze its profitability over its entire life, not over a particular year or over a number of particular years. Now, here we have some stages of life cycle costing or product life cycle. Stage 1, stage 2, stage 3, stage 4, and stage 5. Kindly read these stages. I discussed these. Kindly read it, quickly read it, then we will move forward. Okay. Any question? Any question?
No, sir.
I repeat the question. Any question?
No.
Okay, I can't hear you properly. If you can write in a chat box, that would be great. Okay, Priyanka. Okay. Okay, now look at the example 3. Z developed a new computer game during X2 for $200,000. The game will be launched in X3. Budget, revenue, and cost of the game over its life cycle are presented below. Now, in X2, you can see there is no revenue, there is no variable cost, there is no contribution, but there is marketing cost, there is development cost, and actually, we are making a loss of $240. In X3, when we launch the product, we start to earn the revenue. We have some variable costs, and we start to contribute. The product started to make a contribution. Now, marketing cost is declining, and our actual profit of X3 is 100, and we have recovered the loss by 100, so remaining loss is now 140. Now, in X4, again, we have a significant increase in the sale, in a contribution. There is no marketing, there is no development cost. So now we are start to make huge profit, and we have recovered our cost. And by the X5, till the end of the life cycle, if X5 is the end of the life cycle, we have accumulated a total profit of 235. So this is an numerical explanation of the life cycle cost. Now, here the total variable cost, if we do calculation, the total variable cost is 150, total marketing cost is 70, and total development cost is 200. So we have total 385 total cost over the life cycle, and the total output in terms of units is 62,000 units. So per unit cost is 6.21 per product over the life cycle. Since the sale price is $10, so we are making 3.79 profit over the life cycle per year. These are the number of units: 16, 34, and 12. And 160, 340, and 120 is the total revenue. So $10 is the per unit cost. So we are making 3.79 profit over the life cycle. And if we are making the profit over the life cycle, then we should go with the product, because the product is a profitable product. Now, cost involved. So for life cycle costing, 3 stages can be identified in a product line. The first is planning and designing stage. The other one is manufacturing, production or sales stage. And then service and abandonment stage. These are the 3 main stages. During the planning and design phase, many decisions about the product design will determine the cost that will be incurred in the future. These are committed costs, although not incurred during the design phase. The company is committed to incurring future expenditure, mainly during the manufacturing. Tools such as target cost may be used to reduce such committed costs if they exceed what is acceptable. The pattern of the expenditure will vary from industry to industry. It is common for committed costs during the planning and design phase to reach 80% of the total cost of the product lifecycle. So in an early stage where you are designing the product, that would be the main stage, which will decide your committed cost, which you are going to incur. If you carefully design, properly design the product, then it would save you a lot of cost in the future, and it would contribute towards the profitability of the product. No. And if you do not take care the the cost in a design stage, in a planning stage, then obviously in the coming time, it would be difficult to reduce the cost and you would not be able to achieve the profitability. So in a product life cycle or in a life cycle costing, the planning and design stage is very important. And we should be very careful during that stage. The cost behavior in a product life cycle, in the planning and stage, product design, building prototypes, market research, these are the fixed costs. In planning and design, there is no variable cost because we are not manufacturing anything. During manufacturing and sale, marketing cost, fixed production and sale cost and design updating would be the fixed cost. Material component, labor cost, variable overhead, sale commission would be the variable cost during manufacturing and sale. And when you have sold the product, then it will come service and abandonment. In that case, when you are going to abandon the product, there will be a decommissioning of factory cost, disposal of product cost, that will be a fixed, and service cost involved. You abandon the production. Now you're not going to manufacture that product, but product is still in the market. Customer is continuously buying, or they have bought the product in the past. So there will be a need of providing the services. So after the abandonment of the product, you will continue to provide after sale services. Now we know you have many examples around you where a particular company 10 years ago start to produce a particular product, and they very successfully sold that product over 10 years, and people are now very used to. But after 10 years, they abandoned the product and they are now going to launch a new version. But abandoning the product doesn't mean that you discontinue the after sale services. You will continue to provide the services. That cost is known as servicing cost. You may decide to continue to provide services on your own, or you can outsource. That is another issue. But that cost will be involved at the time of abandonment. Abandonment means the end of the life cycle of the product. Now, in a product life cycle, we have initial idea phase, development, and when introduce the product, then there is a growth, and then there is a maturity stage. And after maturity, there will be a decline. Now, during the maturity stage, the strategy of the company should be that they should try everything to extend the maturity stage of the product. Now, the challenge or the question is that how they can extend the maturity of the product. That is the question mark. Now, for that purpose, we have certain strategies like issuing updated version of the product, which include new features. The cost of developing update for an existing product are likely considerably less than the cost of creating an entirely a new product. You are selling a product. The product is very successful. It is in a maturity stage. But if you continually updating that product after every 2, 3, or after every 1 year, if you are giving a new feature in a product, a new, you can say, option in a product, it would extend the product life cycle. It would extend the maturity of the product. And keep in mind, modifying a new version in an existing product is less costly as compared to making entirely a new product. So that would be a strategy to extend the maturity stage. Like if we talk about the mobile phone, telecommunication sector, mobile phone sector. The mobile phone set technology is obviously now in a maturity stage. Now everyone has a mobile phone, it is a maturity stage, but its maturity stage has been extended because after every year, iPhone launching a new iPhone with a new so-called you can say feature. Samsung introducing after a year or after every 6 months a new mobile phone with a new feature. So it would help them to extend the maturity stage of the product. Number two, repackaging the product to give a new image. Product is old, but if you change the packaging of the product and you can make an attractive packaging, then obviously it will attract the customer and it will help you to extend the maturity stage. The last and not the least, the third strategy would be selling a product in a new market. Now, let me give you an example. Like we know that now we have the EV technology in automobile industry, electric vehicle. Before electric vehicle, there is the hybrid technology, and before that there was diesel cars or petrol cars, gasoline cars. Now in Japan, the hybrid car was introduced decades, maybe in early 2000, they have introduced the hybrid car. But in a developing country, the same Toyota, Honda, Suzuki companies were selling the simple cars. Like if I talk about the South Asia, they were selling the simple cars, non-hybrid cars. If a customer need a hybrid car, they need to import it from the Japan. But now in a Japan or in a Western countries, now they are moving towards the EV car. So the hybrid technology is uh, getting old there. It is outdated there. So what they have now started to do, what Toyota or the Honda has started to do, they have transferred that technology in a country like Pakistan. Now they have transferred their hybrid technology production in a Pakistan, in a subcontinent. So by doing this, by transferring the old technology in a new region where that technology was not previously used, obviously it will help the company to keep the product or keep the technology in the market. So it is also a very, we can say, important strategy to extend the maturity stage of the product. So these are the some techniques, some ways, some strategies which the entity can use to extend the maturity of the product. Now, these are the some benefits of life cycle cost. So kindly read the benefits. If you have any questions, please let me know. Read the benefits. Yes, do you have any question on the benefits of the life cycle costing? Life cycle costing encourages management to plan the pricing strategy for the product for the whole product life rather than on a short-term basis. That would be the benefit that you will be focusing the total life of the product rather than 1 or 2 years. Now, identifying the cost incurred throughout the product life means the management understands them better, enabling management to control them better. It would be a benefit. By monitoring the product revenue and cost on a cumulative basis over its life, management is provided with more meaningful information for control than it would have by monitoring cost and revenue period by period. It is much easier to design out costs during the design phase of the product than to control out costs later in the product life cycle. We discussed this thing that in a design stage, uh, the design stage is a stage which will decide that how much the product is going to be a costly product. So if you do the design carefully, if you plan the design stage carefully, in that stage you can control the product cost in a coming year as well. So by focusing the total life of the product, you will be focusing on the design stage as well. And when you will be focusing the design stage, then it would give you a better understanding of the product cost and you would be in a better position to control the cost. The decisions about whether to continue developing and manufacturing products will be based on complete information when the product life cycle is considered, where the cost and revenue are monitored on a period by period basis. So whether you are going to discontinue the product or you are going to continue the product, if you are using the life cycle costing, will be based over the entire life of the product rather than on a specific period. And obviously that is a better thing because again, same thing when you are focusing over the entire life of the product, it would give you a better understanding. So it is an extra benefit of using the life cycle costing concept in a management account. Got it? Any question? Now, life cycle costing is also application of life cycle costing on a service sector. It is also applicable on service sector and it is very useful in a service sector as well. Like for example, if we talk about a financial industry, like a banking sector, banks in the early stage may attract the customer and they may give them a lot of services and it would may give them initial losses, but in the hope that if they retain the customer, it will give them a benefit in the future. So when they are providing a service, they are not focusing on a year one profitability from the product, but they are focusing on the profitability over the 10 years or 5 years or 6 years. So it is an example where a life cycle costing can be used in a service industry. Similarly, if let's say in a recent time, if we talk about whenever a app is launched, um, like any like Uber, like InDrive, like any app with a new idea at launch, you can see that in the early times of launching the app, they give lot of incentives to the customer, which increase their cost. But they are incurring the cost in a hope that if they retain the customer and they make a customer to use the app in the long run, ultimately they would be making a profit. So it is also an example where uh, The service industry can use a life cycle costing or is using a life cycle costing. So life cycle costing concept is also very important for a service industry as well. Now let's read it. Life cycle costing is relevant to services that require significant upfront research and development. An example is the software industry, where considerable research and development are invested in a new application or operating system. The cost of this development must be recovered before software becomes obsolete. Life cycle costing can also be performed concerning customers. The cost of providing goods or service to a customer may be vary over their life as customers. Some business incur high costs in setting up a new customer. However, having attracted a new business, the cost of maintaining the customer relationship is likely to be much lower. An effort is therefore directed to ensuring customer loyalty. For example, the following one of the costs might be incurred by the retail bank at the start of a new customer life. Financial incentive, below market rate interest on borrowing for 12 months, initial registration, including validation of personal detail and an identification of the customer, credit worthiness check if loans are to be provided, setting up bank account, issuing user ID password for internet banking. They provide free of cost, and they're providing these services free of cost or at a less cost in hoping to retain the customer. And once they retain the customer, then in the future they have to incur less to retain the customer, and then they can make the profit from the customer in the future. So these are the examples where the life cycle costing is much relevant to the service industry as well. Okay, so this was the concept of the life cycle costing, which we use in a management accounting or a cost accounting. Now, first of all, we will do some practice question on this concept, and then we will move towards a new topic, which is, I think, the next topic is the theory of constraints. Theory of constraints. But before that, we will take a break. After the break, we will do first of all the practice on the written question, specifically on targeting the objective test question, section A. Then we will talk about the theory of constraints. So, I'll take a break, and after the break, we will resume the class. Okay, welcome back. So, question on life cycle costing. A company has produced the following information for a product it is about to launch. The product is expected to have a life of 3 years. Year 1, year 2, year 3, and expected sale units 2,000, 5,000, and 7,000. Variable production costs, fixed production cost, variable selling cost per unit, fixed selling cost, and administrative cost are given. The question is, what is the life cycle cost per unit? This is the question. Now, first of all, you need to calculate the variable cost, total variable cost, and the total variable cost will be, for year 1, it will be 2,000 into 2.80, 2.3 and plus 0.5. For year 2, it will be 5,000 into 2.20. And for third year, it would be 7,000 into 1.60. This will give you the total variable cost of the product, and that will be, total will be 2,000 into 2.80. What will be the answer? 2,000 into 2.80. And then 5,000 into 2.2. And then 7,000 into 1.60. Can you calculate for me? Yes, students, 2,000 into 2.80. And then 7,000 into 1.60. So these will be the answer. And if you total them, the total variable cost will be 27,800. 27,800 600, 11,000 and 11,200, and total will be 27,800 will be the answer of total variable cost. Now the total fixed cost in the first year, it will be 3,000 plus 1,500 plus 700. That would be 5,200 in the first year, 35 for 51, 5,800 in the second year, 4,000 plus 1,600, 5,600 plus 7, it will be 6,300. This will be the total fixed cost, and if you total it, it will give you the 11,000, and 11,000 plus 6,300, it will give you 17,300. Now what you need to do, you need to sum up the 17,300 with 27,800. So it will be 45,100 will be the total cost. And total number of units are 2 plus 5, 7, 14,000. So 45,100 divided by 14,000, you will get your cost per unit over the life cycle. And it will be 3.22 will be the answer. So option C is your answer. Got it? Yes, students. Any questions? Any questions, students? The question number 49. And the requirement is, what is budgeted life cycle cost per unit? Budgeted life cycle cost per unit. Similar requirement, but in terms of budget. So, a manufacturing company which produces a range of products has developed a budget for the life cycle of a new product field. The information in the table, in the following table, relates exclusively to product field. Design cost $800,000. Design cost is $800,000. Then direct manufacturing cost is $20 per unit. Depreciation cost $500,000. Decommissioning cost $20,000. Machine hours cost is $4 per unit. And the production and sales units are 300,000. The company total fixed production overhead budgeted to be 72 million US dollars for each year. And total machine hours expected to be 96 million hours. And company absorbed the overhead on a machine hour basis. So first of all, you need to calculate the overhead absorption rate. And the overhead absorption rate, you know, will be budgeted overheads divided by budgeted activity. So 72 million US dollars divided by 96 million machine hours. And if you solve it, 72 million divided by 96, you will get absorption rate of $0.75 per machine hour. Per machine hour. And your total manufacturing cost is $20 per unit in terms of unit. And you are going to produce 300,000 units. So manufacturing cost will be 20 into 300,000. So 20 into 300,000, it will give you total 6 million US dollar. You can say 60 lakh US dollar would be the total direct manufacturing cost. Now we left with the depreciation cost, the commissioning cost, and design cost. Now if you total these costs, 800 plus 5, 13. It would be 13 lakh, 13,20,000 will be the total design, depreciation, and decommissioning cost. And each unit is going to take 4 hours. So the total cost will be 6 million plus 13 lakh 20,000. Overhead absorption rate is 0.75 machine hours. You are going to produce 300,000 units, and each unit is going to take 4 hours. So you are going to take total 1,200,000 machine hours. You are going to take 1,200,000 machine hours, and overhead absorption rate is 0.75. So 1,200,000 into 0.75. 1,200,000 into 0.75, and you will get your total overhead, production overhead. So 300,000 into 412 into 0.75, it will give you total $900,000 overhead. Now, if you sum up all these costs, 6 million, 60 lakh plus 30 lakh 20,000, it will be 73 lakh 20,000, and 9 lakh, it will be 82 lakh 20,000 US dollar will be the total cost. And you need to calculate the budgeted cost per unit, and we are talking about total life cycle costing. So it will be the total cost over the life cycle, and we are going to produce total 300,000 units over the life cycle of the product. So 82 lakh 20,000 divided by 300,000 divided by 300,000, your per unit cost will be 27.40 almost. 27.40. 82 lakh 20,000 divided by 300,000, and the option will be C. So option C will be your answer. Got it? Yes, student. Any question? Okay, then now you have question 50. So you have a question, and requirement is, which of the following statement made by chief executive are true regarding the cost of control? Regarding the cost of control. Number one, the cost per console calculated using the life cycle costing principle is higher than the price customers are prepared to pay, or more attention to R&D cost in X0 could reduce warranty cost in later years. Now, these are the two statements made by the executive, chief executive. Now, which statement is right? We need to tell me. So, let's read the question. S&T is a Japanese electronics giant specializing in production of game consoles. S&T is planning to introduce the latest next generation console and range of games in summer of X0. The development of a new console is due to commence on January 1st X year, and S&T is currently working out what price the new console should be sold. Then the new console is expected to incur the following costs in 4 years till it will be developed and commercialized. Console manufactured and sold X0, X1, X2, and X3, 10, 12, 11.3 thousand respectively. Then we have research and development, marketing cost, production cost per console, warranty cost per console, and end of life cost. Marketing and research has indicated that customer will be prepared to pay an average price of 420 per console, but S&T chief executive believes this will not be sufficient to make production worthwhile. So on the basis of that, the question is, which statement is right? The cost of per console can be calculated using life cycle costing principle is higher than the price. You need to calculate whether the cost per unit is higher than the price proposed by the marketing department 420 or not. Or more attention can be made to R&D in X0 to reduce the warranty cost. These are the two statements. Now, for that purpose, obviously, first of all, you need to calculate the total cost over the product life cycle. And if we can do the calculation, R&D cost will be total 9,50,000. The marketing cost will be 230 plus 120 plus 20 and plus 5. It will be total 3,75,000. And then production cost per console. 10,000 into 450 plus 12,000 into 430. Then 11,100 into 290 and 290 into 3,000. I multiply the units to the cost per unit of production. And if you sum up the total cost, it will be 13749,000. 13.74 million. 13.74 million will be the total production cost. Then we have a warranty cost. Again, 3 lakh in X0. Then 12,000 into 30. It will be 3,60,000 in X1. And for X2 is 40 into 11,100. And 45 into 3,000. And it will give you a total of 12,39,000. 12,39,000 total warranty cost. And end of life cycle cost will be 1,25,000. So the total cost will be, if you sum up it, it will be 164,38,000. This is the total cost of the product over the life cycle. A number of units which we are going to produce are 10 plus 12, 22, 33,100, 34,000, 10 plus 12, 22, 22 plus 33,100, 20, 22, 23,100 and 3, 36,100. 36,100 units we are going to make. Now, if we divide the total cost by 36,100 units, your cost per unit will be 455, almost 455 is the cost per unit. And you're suggesting the sale price of 420. That means statement 1 is a true statement. Statement 1 is a true statement. We agree with it. Now, if we make more attention, the cost of R&D in X0, then it could reduce the warranty cost later year. Yes, it's true. It's true. It seems true. If we uh, make the product design properly, we make the production process properly with cost efficiency, then if there are less warranty claims in the future, defects are true, then obviously warranty cost will be reduced. And if we reduce the warranty cost, it is 12,39,000. And when I say 12,39,000 divided by 36,100, you have a significant reduction in cost per unit. Significant reduction in cost per unit. So yes, it will helpful. So statement 1 and 2 both are the true statements. So the answer will be yes. The option D will be the answer. Option D will be the answer. Got it? Any question? Okay, while a drag and drop style question is impossible to, okay. Which four of the following are said to be benefits of life cycle cost? So which of the four are the benefits of the life cycle cost? Can you identify? What about one? It provides a true financial cost of a product. Is it a benefit of life cycle costing or not? Yes, it's a benefit. So this is one. The, the length of the life cycle can be shortened. Life cycle costing can shorten the life cycle, product life cycle. No, yes, it's not a benefit. So this is not will be the part of the answer. Expensive error can be avoided in that potentially failing the product can be avoided. Yes, what about number 3? Is it advantage or not? Yes, it's an advantage. Because in life cycle costing, we focus on every aspect of the product and even the design. And if we can design the product properly, we plan the product properly, obviously the errors can be avoided and chance of failing would be avoided. So it is an advantage. Lower cost can be achieved earlier by designing the out Cost, yes. Yes, we have read it. This is an advantage. Better selling price can be set. Yes, the better selling price can also be set. Decline stages of the life cycle costing can be avoided. No. The decline stage cannot be avoided. There will be a decline stage. Yes, we can delay the, you can say, decline stage, but there will be a decline stage. So 1, 3, 4, and 5. These are the advantages. These are the advantages. So which of the following statements are true regarding the justification of use of life cycle costing? Okay, read the statement and tell me which of the following statements are correct or true about life cycle costing. Read it and let me know. Yes, students. Product life cycle are becoming increasingly short. This means that the initial costs are an increasingly important component in a product overall cost. Is it justifiable? Yes, it is justifiable. If product life cycle is short, then initial cost increasingly important to becoming important component. Number two, product costs are increasingly weightage to start of the product life cycle, and to properly understand profitability of the product, these costs must be matched to the ultimate revenue. Yes, it is the concept of the life cycle cost. Because in initial year, the costs are increasing. So we have to compare it with overall revenue. Yes, it's true as well. True as well. Number three, high cost research, design, and marketing in an early stage in the product life cycle necessitate a high initial selling price. No, it's not necessary. It's not true. It's not necessary. It's not necessary. Traditional, so the three is not right. So that means option B, C, D are out of the question. So obviously option A is the then answer. We have left with no option. Option A will be the answer. So the fourth statement will also be right. Traditional capital budgeting technique do not attempt to minimize the cost or maximize the revenue over the product life cycle. Yes, it's true. Traditional budgeting technique do not attempt to minimize the cost or maximize the revenue. It's a problem with traditional budgeting. We will talk about the budgeting later on. So 1, 2, and 4 are the true statements, and 3 is not the right one. So every option with the 3 will not be the answer. So B, C, D is obviously not the answer. So the option A is the right answer. Now 53. Which of the following statement is or true regarding the life cycle costing? Please let me know. Read the 53 and let me know that which statement is true or yes, student. What about statement 1? Is it true? Life cycle costing take into account all costs incurred in a product life cycle, exception of sunk cost. Sunk cost means irrelevant cost, the cost which is already incurred. No, it's not true. Because the concept of sunk cost, committed cost is, is the topic of relevant costing, not the life cycle cost. In life cycle costing, we consider all the costs, whether they are relevant or irrelevant, sunk cost or not sunk cost. So one is not the right option. Life cycle costing ensure a profit generated over the life of the product. Yes, the second statement is true. Third, life cycle costing is most useful for product with an even weightage cost over their life. No, not even cost. It is useful when the costs are not even. In a life cycle costing concept, basically the concept is that in initial year the cost is high. And in a later year cost is low and revenue, the sale price would be the high. So the third statement is not the true statement. Let me explain. In life cycle costing, for example, year 1, 2, 3, the sale price would be 100, 100, and 100. But cost in initial year will be 120, then it will be reduced, and then there will be a significant decrease. So this is the concept of the life cycle cost. Even cost means in each year we have a same cost. So third statement is not the right. So again, we have option B, which is the right option. Got it? If you calculate the answer and let me know what is the answer of question 54. Calculate it. Okay, you need to calculate the life cycle costing per unit. Manufacturing cost is $15 per unit, 43,000 for design, and 30,000 for decommissioning. So 43 and 30 are the total cost. Fixed cost, let's say 73,000. Total activity is 20. 73 divided by 20, you will get 3.65 and $15. And the $15 is the variable cost. 3.65 plus 15, so you have 18.65. So option A will be the answer. Option A will be the answer. Got it? Yes, 18.65. 18.65. Okay, students. So that was the concept of life cycle costing. Now, the next topic we have is a theory of constraint or a bottleneck resource. It is also known as throughput account. Now, what is bottleneck resource or theory of constraint? Look at the picture. We will talk about it in the next class, but let's have a concept. Bottleneck resource means that in a process there is some limitation in some of the resource which create a hurdle in your production, that you cannot use your maximum capacity. Like for example, if you look at the example number 4, you make a product, let's say, and that product goes through from 3 machines or 3 processes. Now, the process 1, the machine 1 has a capacity of 200 units. It can produce 200 units, process 200 units. Machine 3 can process 210 units, but machine 2 can process only 180 units. So in this case, this machine 2 is creating a constraint. It is a bottleneck resource. So you cannot produce more than 180 units. That is a bottleneck resource. Got it? What's meant by the bottleneck? Machine 1 can produce 200, machine 3 can produce 300, but machine 2 can only produce 180. So if the machine 2 produce only 180, that means even if you produce 200 units from a machine 1, in a machine 2, they cannot be fully processed because machine capacity is only 180 units. So it will create a bottleneck resource. It will create a bottleneck resource. And it is known as theory of constraint. Got it? Now, another aspect. Now, if you update the machine 2 by 20 units, and let's say we increase the capacity of machine 2 up to 200 units, then machine 1 can produce 200, machine 2 can produce 200, but machine can produce only 300, can produce 210 units. In that case, the machine 1 and machine 2 will become a constraint. So when you enhance the capacity, then there will be another constraint. And then if you further increase the capacity of machine 2 and increase to 2 times, so machine 1, machine 2, and machine 3, now all 3 machines can produce 210 units. Now it seems that there is no bottleneck resource, but there is another bottleneck resource, which is a market demand. Now, if in the market the maximum demand is 205, then again it means the market demand will become a constraint. Now, this theory is known as theory of constraint, and this is known as bottleneck resource. Now, in the presence of bottleneck resource and in a constraint, how we can maximize our profitability that is the concept of this topic, theory of constraints. It is also known as a throughput accounting concept. But this topic we will discuss in the next class with detail and with the practice question. So till then, goodbye and take care. See you next week.